Welcome, everybody, to your final week of Finance 231. For some of you, this will be exciting to just have a final this week and prepare for that. For others, it will be kind of a stressful week. Many of you, a handful of you, are missing assignments, missing discussion boards, missing assessments. As we talked about in the first session, you've got until the end of this week to turn everything in. You may not get full credit for things that are turned in late, but you will still get the majority of the credit. So it's well worth your time this week to um, you know, buckle up and make sure that you get sufficient work done so that you can at least pass the class. I put out an announcement today to that end, and I'll encourage you via an email probably tonight or tomorrow as well. But for any of you who happen to be listening to this recording session and are wondering whether or not you can, at this point, make up enough of the work, if you find yourself behind, I would just strongly encourage you to really carefully plan out this week, give yourself adequate time and put adequate effort in. But if you'll do that, I'm positive that you can still get enough done to pass the class at this point, even if you find yourself behind. So I'd strongly encourage you to not give up and to do your best this week and just see, based on your efforts, be able to pass a class like this and get through it so you don't have to take it again. I hope that not many of you are in that situation. I hope that most of you are in a situation where this week will be more about preparing, doing the daily checkpoints, but preparing for the final. The final does have 36 questions. It is worth 180 points, so it's the most significant piece of work that you'll have done to this point as far as the points available. You will notice on the final that many of the questions you've seen before. That should help most of you. Although I realize that some of these questions have been tricky for some of you. But if you take notes from the sessions that we've had, if you read the chapters and carefully study them, you should be in good shape, along with what we provide tonight as far as the notes. And we'll spend probably the last 10 to 15 minutes going over the final questions, giving you, as we always do each week, the topics that you'll need to know for the test this week. So hopefully for many of you, this will be a pretty light week as far as coursework. But you'll want to read chapters 7 and 8. You'll want to study through those. You'll want to take some notes from the session, and you'll want to feel like you're adequately prepared for the final once you get to it. Okay, so tonight we're going to cover chapter 7 and 8. We're going to cover what is required on the final, what the topics are going to be on the final. Other than that, and without any live participants tonight, I think I'll just go ahead and get started. If you have questions or concerns as you review this during the session, if you'll just zip me a quick email whenever you happen to be reviewing this, I'll go ahead and try to solve any issues or problems that you may have right away. If to this point in the class you have turned something in on time and it has not received a grade, please zip me an email. Even if you're concerned that maybe I haven't seen some late work, zip me an email. It never hurts. It's not like I'm going to dock your score or something like that for you emailing me about even late work that you submit. And the only reason I say that is because sometimes, based on a glitch in the system, we miss an assignment, even though it appears and it shows that everything has been graded to this point. If something that you've turned in has not been, be sure to be in touch with me right away. And first of all, the first line of defense is to make sure that something did get submitted. Every class I seem to have at least one or two times where someone will think that they submitted or think that they were able to get an assignment in, and then they don't receive a score because I can't see anything on my end for some reason. There was some kind of glitch or error in the system, and I never got the assignment. So double check that I've received everything, and then double check that you've got a score on everything, especially this being the final week. And then, like I say, please, please, please don't give up. You still got plenty of time this week, even if you had a couple days where you could devote sufficient hours and effort into getting enough done to pass the class. I think that's well worth your time. Obviously, I think that's well worth your time so that you don't have to go to the expense of retaking and also go to the effort of retaking a class like this. All right, so since this is the last week, I also want to encourage all of you to obviously finish your degrees. I'm excited for all of you going back and getting a degree. I'm just finishing my MBA right now. I have a master's degree in financial services already, but I'm finishing an MBA. And so I'm in school at the same time that I'm doing this, and I understand how tough it is. I mean, I graduated with my undergraduate degree 12 years ago, and I'm not really in the school mode. I've been in the career mode. And so while I'm working full time and have young kids and been working on designations and doing, all kinds of other things, I've also been, teaching, but also I've been taking classes, and so I understand the work-life balance and how tough that is when you're trying to go back to school as well. But I'm excited for you just as much as I'm excited for myself to have, that degree and the opportunities that will bring. So just strongly encourage you to continue. If you even if after you get through this class, if you have any concerns or questions, career issues or questions that you want to zip over to me as far as questions that you might have, feel free to. And the same goes for any concerns or questions that you might have regarding investing. Now that we're done with this investing class, I mentioned at the beginning, you're going to know more about investing or the basics of investing if you read through the chapters and if you listen to these sessions, the 99% of the people out there that you come in contact with. Even though you'll know that much more than most of everybody else out there, it doesn't mean that you won't get stumped by something or just have some concerns about something. So you're welcome to maintain my email and give me a call or email me anytime, even after the class is over, if you've got concerns or questions. All right. So tonight we're going to talk about how we go about analyzing stocks and how it is that we determine whether or not a stock is good or bad, or the kind of stock that we want to invest in. And the same type of research and the same type of information can be used when you're trying to evaluate one career option versus another, or one company versus another. Let's say you graduate with a business degree and you've got two different offers on the table from two different very good companies. One of them's 3M and one of them's United Technologies. And both of these companies are very well known. They've got great history. They're both very big companies. And you probably have good offers as far as, the type of good paying, high benefit jobs that you would expect. So how do you make a choice between those two? Let's say everything else being even, between two different companies. And I would suggest that one of the issues, if it truly is very close between two different companies, one of the things that you could do is you could do your own research, which you probably should do before interviews, live interviews anyway. But you could do your own research about these companies the same way we'd research a stock and determine which one you feel like is stronger. And I would submit that that's a valid way to pick between two, other than that, equal options as far as employment. Because you want to work for the strongest and best company that you possibly can. And the same information, the same research that we use to pick a good stock is the same research that you could use to evaluate one company versus another when it comes to your career choices. So just something that you could use it for. Another thing that you can use it for, and this is something that we've talked about throughout the course, is that the stock market can be a very good place to invest for the very long term. So many of us, when we're going back to school, we don't have a lot of resources to invest really long term. We might have short term resources, but sometimes we feel like we don't really have a lot long term. As soon as you have a career that you feel is stable and good, and you have an income that allows you to have some discretionary available funds each month, I would highly encourage you to consider using an IRA or some sort of tax efficient investment like an IRA to invest for the future. And whether or not you use mutual funds or stocks, this information that we talk about tonight would be applicable to researching mutual funds just like it would researching stocks. So let's talk about how people analyze stocks and how you can analyze companies. So what is security analysis? Remember, we talk about how securities are stocks. The process of gathering information, organizing into a logical framework, and then using it to determine the intrinsic value of a share of common stock. That is a very flowery way of basically saying you organize the information that you find to make it usable and helpful, and then you try to determine the value associated with that stock, not looking at the price of the stock. Remember, and I don't know if we've talked about it in this class, but I always am careful to mention at this point that the value of a company is not based on the price of the stock, right? You can have a stock that's worth hundreds of dollars with one company, and another company has a stock that's worth $5, but yet the company that stock is worth $5 might be worth more than the company that stock is high priced. Why is this? Because it has to do with how many shares are out there. So we buy stock in shares, right? So if I buy a share of stock, that's a share, that's one small share of that company ownership. That's what we call shares. So if I buy a share of Disney stock, I have very little ownership, but I do have one share of stock ownership in that company out of the millions of shares that are out there. Now, going back to the issue that I just brought up as far as pricing, okay, and this is a very important concept because a lot of people don't understand this even as investors. So if I have a $15 share company and I have a $200 share company, okay, so this one costs $200 per share and this one costs $15 per share. Most people, even very educated people, consider the company that has a $200 stock to be the more valuable company. And what I was just barely bringing up is the fact that the stock price times the shares, the total shares, is how you come up with the value of the company. Okay, so there's two different parts to it. There's the price. Okay, my dollar sign's pretty crazy right there. And then there's the total number of shares. If this company has fewer shares, much fewer shares, and this company has lots of shares, so millions of shares, okay, there's a chance that this company that's a $15 stock may be worth far more. The company itself may be worth far more than the $200 a share company. Okay, it just depends on how many shares are out there. And when you're comparing the size of two different companies, you just take the share price times the outstanding shares, which you can find on a company's financials, and that gives you the total market capitalization of those companies or total market value of those companies based on the share price. But it's a two-part component. It's the share price times the total shares that are out there to get to that end value between the two companies. So it's an easy way to compare the size of different companies or the size of two companies is to take the share price times the outstanding shares, and that will give you how big the company is. And like I say, companies with small share prices might still be more valuable or very valuable based on the fact that they might have fewer shares outstanding. Okay. All right. So real quick, we want to make sure and talk about how you value different positions. So let's keep going with our information here. So when we talk about analyzing intrinsic value or the pure value of a stock, we're talking about fundamental analysis, what's called fundamental analysis. And the most successful fundamental analyst, fundamental investor of all time, and happens to be one of the richest people in the world as well, he goes back and forth with Bill Gates as far as being the richest person in the world, is Warren Buffett. Warren Buffett never started and ran his own company. What he's always done is he's invested money in other companies, and the way that he evaluates which companies to invest in is based on what we're talking about here, which is fundamental analysis. He goes through a company's financials and determines whether or not that company is a good value for the money. And if he feels like it's a company that's undervalued, he'll purchase. If he feels like it's a company that's overvalued or fairly valued, he just won't buy it. Okay, so that's how Warren Buffett has made his billions of dollars over the past 40, 50 years, is by doing what we're talking about right now, which is fundamental analysis. So it's the method by which we analyze a company, analyze a stock, and we try to come to a conclusion or come to a value that we call its intrinsic value. And if that intrinsic value is less than the stock price, that means that the stock price is overvalued. If the intrinsic value is above the stock price, that means the stock is undervalued and potentially a good buy. Okay, potentially a good opportunity to buy. All right, so investors who use fundamental analysis are always trying to find, by using the financial information provided them, that's public information that we can find readily, like we talked about in week 2 on the internet, We can find that information. It's verified information. It's accurate information, and we can evaluate whether or not a company is undervalued or overvalued by that information. A top-down analyst, or an analyst who evaluates stocks or investments based on a top-down approach, is one that first of all looks at the economy, the whole economy. So they'd say, okay, how is the U.S. going to be doing over the next few years as far as the GDP, the gross domestic product, the growth associated with our country, unemployment, interest rates, all those kinds of things. And that's their first factor. And that right there can help them determine whether or not they invest at all, right? So if they feel like the economy is going to go into recession, they might decide, based on being a top-down analyst, to just not invest at all. But then after they do the economic analysis, assuming that they come up to a conclusion that they feel good about what the economy will do over the next few years, then they go to industry analysis, where they look at different industries and they try to gauge, based on what they found with the economic analysis on step one, which industries will do best. And there's a lot of history on different industries doing best during different types of economies. If we're in a fast-growing economy, cyclical products like Harley-Davidson, Tiffany & Company, companies that benefit by people having excess money will do very well. If the economy is going to be fairly flat or even go down a little bit, then consumer staples will do well. Consumer staples would be companies like Procter & Gamble, who supply Crest and toilet paper, products that most of us still continue to use even if the economy goes into recession, okay? So that's why they look at different industries, because different industries react differently and perform differently and are good or bad based on what the economy is doing. Then they go one step further, and once they have the industries that they feel like are good opportunities, then they go down to specific companies within those industries, compare them, and come up with their favorite choices within those industries for who they should invest in. Okay, and sometimes, if the in the right economy with a positive, situation for a lot of different industries. Excuse me. They might come up with multiple companies that could be an option for a portfolio. But then other times, in a bad economy with industries really struggling, they might not come up with any stocks, and that's just part of an analyst's lot in life. Sometimes there's lots of options and sometimes there are not. We talked last week a little bit about making efficient portfolios. And efficient market hypothesis basically says that the economy, the investing world, basically makes the stock market efficient. What does that mean? It means that whatever a stock should be priced at, it will be priced at, because there are a lot of smart people, hundreds of thousands of smart people investing, and they're going to buy up pricing, and pay more for companies that they feel like are worth more. And people who think companies are worth less are going to pay less for the companies. And because of that supply and demand from all these people who are investing in stocks that should be lower priced are going to go down in value until they go to that lower price. Stocks that should be a higher value are going to go up in price until they hit that higher value. And so basically the idea of an efficient market is you have a situation where stocks are usually fairly priced if you believe in efficient markets. Most fundamental investors believe that markets are for the most part efficient, but that investor personalities, investor moods, investor activity create situations where there are dislocations or opportunities for advantage, by investing smartly. Okay, where somebody who believes purely 100% in efficient markets would say, you can do as much research as you want. People have already done it, and the price that you're paying is the fair price for what that stock should be worth. Okay, so it kind of takes out the idea that you're able to do a lot of extra research and find good companies if you believe in efficient markets. But why do we still need fundamental analysis? Fundamental analysis is the reason, potentially, that we have efficient markets, right? Because smart people are finding where pricing should be, and then they're pricing the stock or whatever position it is to that price based on their research. And the idea probably is that you can't really be an efficient market purist. Seemingly, history has shown that there are opportunities to take advantage of different stocks if you've got the right information, if you're analyzing the right thing. And Warren Buffett, once again, is an example of that. He's been highly successful with his fundamental analysis over the years. Economic analysis, you'll recall, is the first step of top-down approach. We talked about how you might look at gross domestic product, might look at government fiscal policy, who's in the White House, who's in Congress, are they going to tax more, are they going to tax less, what are they doing as far as their fiscal management, as far as deficits and debt. Then we can look at Janet Yellen and the monetary policy. She's the chairwoman of the Fed, and she has a lot of power as well. Every time she opens her mouth, the market moves because she controls the board. The Federal Reserve Board controls, to a large extent, interest rates and money supply, which in turn affect the market significantly. And then we're always looking at things like inflation, consumer spending, manufacturing, all kinds of different things that come out in reports. If you watch CNBC almost every day, some kind of economic report comes out, and they analyze it, and then the market will move based on that economic report. Okay, so these are all things that we look at when we're looking at the economy and trying to figure out whether or not it's a good economy for investing. So this is a good graphic, just shows you different things that you can look at and what they actually mean. So if you go down to the bottom and look at housing starts, obviously the housing starts, if they go up, means that there's additional availability and cost of money, is on track to allow people to finance, right? If they're building homes. So one side can tell you the other side as far as the economy is concerned. So you got a lot of different things that can happen in the economy and then have significant impact on the stock market. So we talked about GDP, which is gross domestic product. It can be calculated two different ways. It can be calculated as if it's total income created from an economy, but it also can be calculated as total goods, finished goods created, finished goods and services by an economy. Those two numbers should be equal, actually, even though there's some statistical variation between the two. But in theory, whether or not you get to your GDP number based on taking total income, or whether or not you look at it based on total production, should come to basically the same conclusion. The bottom line is, no matter how you calculate it, if the GDP is growing significantly and the economy is growing fast, that's a huge positive, and that will be a huge positive for the stock market if GDP is going and growing quickly. Okay, so that's one of the examples. There's lots of different examples of things on the left side that can happen with the economy, and then on the right side, what that means for your stock investing over time. A lot of different resources that we can use to get economic outlook. There are the pay subscription services like the Wall Street Journal and Barron's, but there are also just free online articles that you can find very easily about the economy and what's going on in the economy. So MSN Money, CNBC Online, Yahoo Finance, Google Finance, all of these will provide you financial information, as well as just your local newspaper. Most of the national publications have a website now. Most of them have a finance section, and so you're able to get a lot of information on the economy and finance based on these free publications that are all over the place now. Okay, don't necessarily have to pay for it, I guess, is the bottom line I was trying to say. So then you take that economic forecast and what you find out about the economy, and you want to have answered what industries are going to benefit from what the economy is doing. So when you get to industries, we're going to be looking at the competitive position of one industry in relation to another based on what the economy is doing. These are the kind of questions that you're going to be asking yourself. Got some more sources as far as industry, and then we get to our company once we've identified an industry that we want to research. Once we're at companies, we can do a couple different things. We can take the whole industry, right, above a certain threshold and screen for different issues, like how fast they're growing, what is their competitive position, what's their marketing like, how long have they been around, how profitable are they, how much cash flow do they have, how much future cash flow do they have, how much do they pay in dividends. There's all kinds of different things that we can filter for when it comes to finding a particular company within an industry that we want to invest in. And we use their financial statements and we use financial ratios to compare one to another. Why do we use ratios? Because if we're only using the raw financial data, it's very difficult to compare on a relative basis one company's performance from another. Just as an example, if I'm comparing Apple to Fitbit, okay, the company Apple to Fitbit, Apple's numbers are going to make Fitbit's numbers look silly because Fitbit is so small compared to Apple. If I use ratios, then I'm not concentrating on how big one number is versus the other. I'm concentrating on how fast something grew or how efficient a company was or how much debt relative to their equity a company has. And those types of ratios allow me to compare apples to apples. When I'm comparing the raw numbers, assets versus assets, or equity versus equity, or earnings versus earnings, sometimes those numbers are very misleading because I'm talking about a big company versus a little company potentially. So ratios really help me to compare one company versus another and have it be apples to apples numbers. Okay? I can look at their balance sheet, though. We can look at, and compare balance sheets for different companies. I can also take that one company and compare it versus itself, right? Because the balance sheet, the income statement, the statement of cash flows, the change in owner's equity, those statements are going to give me, they're usually going to give me 3 or 4 years on their financials if I'm just looking on a site like Yahoo Finance or MSN Money. And if I'm looking at 3 or 4 years, I can see the growth over time or the change over time to those facts and figures as well. And that's an important component of evaluating financials, is seeing year over year how the company is making progress. Or a company may look very good in one year, but it actually could represent a significant decline from prior years, and that's a trend line that most people don't want to invest on. Talk about cash flow. We talk about other reports that you can look at. Key ratios that we can look at. We've alluded to some of these ratios, but here are some of the ones that you could consider. Shows you the actual formulas for these different ratios. It's good to know what goes into these formulas, although you're never going to have to calculate them because most of them are given to you on a good financial site. So I'm not as interested in you trying to calculate it as I am just in it, as if I were you, as interested in just trying to figure out what has gone into those ratios so I understand what I'm looking at as far as the end number. Talks a lot about ratios and why it's important. Okay? And that's pretty well what we wanted to cover. I know I went through a lot of slides there, but we don't need to get deep into the weeds. We can just be kind of high level with this one. I don't expect you to do a bunch of, digging really deep and doing financial, analysis work. But it's good to have kind of a high level approach and understand just basically how you could compare one company versus another when it comes to investing. Hi, Sabrina. Good night. How are you? Welcome. We're about halfway through. We just got done covering Chapter 7. We're now going to go into Chapter 8, and then after Chapter 8, we're going to go ahead and give you some heads up on what will be on the final. Okay? Any questions or concerns before we do that? All right. I'll take that as a nope, we're good to go. If you've got any questions, let me know. Okay, let's switch now to Chapter 8. We just barely finished Chapter 7. Okay. No worries, Sabrina. I'm glad you're here. Can you hear me okay? Okay. So we're just getting to Chapter 8. We just covered Chapter 7. We talked about some of the housekeeping issues from prior weeks and encouraged you to finish strong this week, being the last week. But we'll go ahead and now cover just Chapter 8 for just a few minutes, and then we'll cover what you'll need to know for the final. So we just barely talked about in Chapter 7 how you analyze stocks, and we talked mostly about how you go about looking at what's called fundamental analysis, and more specifically a top-down approach. So Fundamental analysis just means that you're evaluating a stock and trying to assess a stock's intrinsic value. Of course, you look at their financial statements, you look at different information about those companies, you look at the whole economy, you look at industries. There's a lot that goes into fundamental analysis. But what it all comes down to, okay, once you've done all that fundamental analysis, is trying to evaluate and pinpoint where a stock should be valued. And that's what Chapter 8, that's where we go with Chapter 8. All right. So keep in mind, when it comes to investing in stocks, the number one issue that determines a stock price is what people think that stock will do in the future. Okay, the number one reason that a stock is priced the way it's priced is because of the public's assessment on what they think that stock will do in the future. What does that mean in common terms? It just means that a stock is priced based on how we think the company is going to do in the future. Okay? If we think the company is going to continue to grow and grow quickly, or even grow more quickly in the future, then that stock price will go up. If, however, we think it's a great company, but actually profit's going to go down in the future, and the company's going to slow down, and the company's not going to pay as much in dividends, those types of things will lead to a lower stock price, even, like I say, with a good company. Okay? So let's take a company like Costco. And most everybody who knows of Costco, the people that I talk to really like Costco. Okay? So it's a very popular company. It's a very popular stock too, because people feel like it's a high growth stock because people like it so much. Just as an example, if Costco came out this year and their CEO said, okay, thank you everyone for, your support, and we've had another great year. However, sales were down 20% this year, and we expect that decline to continue over the next 3 or 4 years as people shop more at places like Whole Foods, Trader Joe's, and local stores, kind of a reaction to the big box, national chains. They're going to start going to more local stores, or ones that at least feel more local, like a Whole Foods or a Trader Joe's. Now, they haven't said that, so I'm just giving you an example, Sabrina. But if Costco did say that, and they said their sales were down 20% and they would go down by 20% every year over the next few years, Costco stock would go down dramatically. Okay? Because a lot of people are investing in Costco stock because they expect that company to continue to grow substantially over the next few years. And when you change your outlook, that's what we call an outlook, it can have a significant impact on the price of a stock. Many companies will have good earnings. Okay? When they report their earnings, they'll have good profit, they have great assets, they have good cash flow. But if their management talks about the company slowing down in the future, that is a poison pill when it comes to investing, because investors do not want to be in companies that are going slower. They always want to be in companies that are making positive growth and growing and becoming better. Okay? So just keep in mind, the number one thing that determines a stock's value is the growth prospects of that company. Part of the growth prospects of a company, or the gain prospects of a company, is whether or not an investor is going to be paid for their time. Okay, so we talked about before, when we talk about total return of an investment, we have two parts. One part is the income we receive, and the other part is the gain, right, in the value. So the value of a stock can go up, but we can also get paid dividends over time. So those are the two parts of a total return that we can get from investing in a stock. So as an investor, I'm looking at both those components. I'm not just looking at the gain of the stock price. I'm also looking at how much am I going to get in dividends. And as you can imagine, if I'm not going to get anything in dividends, I better get paid, or expect to get paid, from the gain of the stock. But if I get paid a lot in dividends, I might not have as high of an expectation for the growth of the stock. So another example, utility companies, okay, just your local utility companies like Con Edison, Questar in Utah. These utility companies are all companies that you can trade their stock, and their stocks aren't really meant to go up significantly in value. Most people are investing in utility companies because they pay such a high dividend. And that's the future value that people are investing in when it comes to utilities, in most cases. In most cases, people are not expecting the utility to grow quickly. Most utilities do not grow quickly. However, they do pay very high dividends and have very secure cash flows. So if I'm an investor, once again, we talked about the two things that I have to have as an expectation, or I'm not going to price up or pay for a stock, and that's total return, which you can have two different components. You can either have interest or income, or you can have growth in the value. So as long as I've got one or the other of those that's really strong, I'm going to be investing and buying stock. If I feel like either one of those is going to go down over time, or either one of those is going to significantly, reduce, then I'm not going to invest in that stock. And that's why outlook and potential growth is so important to investors. Okay? And that's why when a company stops or suspends its dividend or reduces its dividend, stocks can take a significant hit and their values can go down significantly. Even if, like we've talked about, even if the company's in good shape, making a change to their dividend can be a huge detriment to the stock price. All right, steps in value in a company. We want to forecast the future sales and profits. We want to forecast the future earnings per share and dividends. Okay, earnings per share and dividends, and we want to forecast in the end, okay, what the future stock price should be. Okay, all of it has to do with future growth, future earnings, future profit, future dividends. There's a theme, right? So those people who you might talk to about stock prices, or you might talk to about the stock market, or you might talk to about mutual funds that they have in a 401k. One of the most common errors people make when it comes to mutual fund investing, especially within 401ks, is they tend to always look backwards instead of forwards. And there's a really easy explanation to that. A 401k company is not in the business of telling you which one of the mutual funds in their portfolio is going to be best in the future. They're in the business of reporting to you what has happened in the past. And unfortunately, in doing so, it leads many people to make significant mistakes, because what they'll do is they'll invest in whatever's been most successful in the recent years, the recent years being 1, 3, or 5 years. When reality is, the market as a whole is not investing that way. The market as a whole is investing in things that they feel like are going to be the high potential and high growth elements of the market going forward, not looking backwards. And so because of that, a lot of times people will invest in things but looking backwards, in their 401k that have been successful, but knowing, as we all do, that everything is cyclical, meaning it goes up and down, right? There's a very high risk that they're going to be investing in something in their 401k, if they do it based on past performance, that's about ready to fall down, okay? That's not how people evaluate and do analysis on valuing companies when they invest. They invest and value companies based on future potential benefit. They do not look at past cycles or past anything. They look completely ahead and forward when it comes to valuing stocks, okay? So that was a lot of information about very little, little content. But the bottom line is, if you come away, Sabrina, thinking, okay, I invest for the future, I don't invest based on the past, you will have learned a lot, and you'll be light years ahead of most people when it comes to investing, because that's a key concept to investing and investing effectively. If we always are looking backwards when we invest, we tend to get hit and whiplashed by the ups and downs of the market. If we're looking forward, we tend to be better off. Doesn't mean that it was perfect, but we tend to be better off overall. All right, we got forecasting. We've got future earnings per share. It shows us how we can calculate or come up with those. And then we come up with that intrinsic price, and we find out whether or not our stock is overvalued, undervalued, or fairly valued. And obviously, if something's overvalued, we're not going to invest in it. If something's even fairly valued, we most likely will not invest. What we're looking for is companies that we can say are undervalued. And a lot of people really get this wrong when it comes to stock investing as well. What they do is they go out and try to find the highest flying, most successful company that they possibly can find as far as their stock is concerned. It would be like going to the store, Sabrina, and saying, okay, I want to buy a lawnmower. Okay, let's say the lawnmower of choice for me is a Honda. And let's say the lawnmower that I have been watching over the past year average price is about $200 for this lawnmower that I've been watching, and researching. Let's say, Sabrina, that this weekend for Father's Day, okay, the price of, or not this weekend, but next weekend for Father's Day, the price of that Honda lawnmower goes up 25% because Sears knows that there are going to be a lot of people shopping for lawnmowers based on Father's Day. Okay, so they've got us. Do we run out and get the lawnmower at 25% higher price, or do we wait for the price to come back down to buy it? Most of us, if we had been researching, right, and if we've been tracking that lawnmower, we're not going to go out and buy it for 25% more than what we've been watching it go for over the past year. In fact, we're going to do the exact opposite. We're going to wait until it goes on sale. If we're patient and smart about how we buy things like this, we're going to wait till it goes on a good sale, and then we're going to buy it when the price has actually gone down. Okay? The same is true for stock investing. Doesn't mean that you wait necessarily for a stock to go down, because there are some stocks that are very undervalued, okay, but their prices are going up. Okay, so it's not the same exact thing, to my analogy with the lawnmower. It's not as simple as the lawnmower. You can't just wait for a stock price to go down and then buy it, because the problem with that is that it might not still be undervalued, and we want something that our analysis tells us is undervalued. And even if the price has gone down, it may still be overvalued for the value of the entity and the future value of what you're buying. Okay? Let me give you an example. Years ago, when Sirius Satellite was competing against XM Satellite, two different companies in the same industry, they were competing for Ford and GM to put their, satellite radio into cars. You probably already know this, Sabrina, but Sirius XM is now one company, but it used to be two companies. And before those two companies combined, they were just neck to neck, really fighting against each other to get the upper hand, signing huge multi-million-dollar contracts with anybody that they thought would bring them subscribership and bring them more business. But it was a fight that almost bankrupted both of those companies. Then when they combined, they ended up being a stronger entity. But as they were fighting with each other, the stock price for both Sirius and XM was going down, down, down. Okay? And if you were looking at those stock prices, you might say, as an ignorant investor, somebody who doesn't look into it and doesn't analyze it, wow, these are good companies. I like Sirius Satellite. I like XM Radio. I think they're good companies. These are good companies in my mind that are out there. They're getting put in a lot of different cars. And the price of the stock is going down. So maybe I should invest in those stocks. And if you would have invested on the way down, it would have been a mistake. Both Sirius and XM went way down. They kept going and going and going and going because they just weren't making money until they finally combined, until they merged, and now they're decent, but they still not even close to what they were back when they were on their own, right when everybody was excited about those stocks at the very beginning. So my point is, even though a stock has gone down in the near term, doesn't necessarily mean it's a good deal. You still have to do your homework, analyze the stock for its financials and its future prospects. And then if you feel like the stock is undervalued based on the stock movement, that's fine. But don't avoid companies who have gone up in price, okay, and look like they're getting more expensive, because when it comes to stock investing, once again, it's all about the future. And the future may be so bright for a company that it's still a really good deal. And people have been saying that about Apple the last 3 or 4 years. Okay, Apple's stock price has gone up a lot. A lot of people look at their stock price and say, that's a very expensive stock. However, their earnings have been outpacing the growth of their stock over the past 3 or 4 years with how many new innovations and new products, and then on the back of the iPad and the iPhone and all the great products they already have, to the point where they're actually considered an undervalued stock by most analysts at this point, even though the stock's gone very, very high. Okay? All right, so that's just some things to think about when you're investing in stock and in the stock market, and when you're looking at your 401k with your mutual funds in the future. Just be sure to be a little more cautious or careful about investing than to just say, okay, whatever did the best over the last 3 or 5 years, that's what I'm going to do going forward. Because that way will surely at some point get you in trouble as far as investing in something that's highly priced and is about to go down. All right. Sabrina, any questions that you have before we get to the test material? Put you right to sleep. Oh, nice. You're probably one of the only ones. Usually I don't have a lot of people in a class like this that have ever invested in stock before. So good for you. I'm glad that you're in the market. And the next step is to be patient with the market, right? It's scary enough to get in, but some people, once they get in, they have a real hard time being patient with it. And let's say Apple stock went down by 20% this year, in the next 3 months. Do you hurry and sell it when it goes down 20%, or do you hang on and wait for Apple stock to come back? I think that if you're a good investor, you're going to do exactly with what you just said, which is you stay patient. You'll be okay as long as the future prospects of Apple are still bright. Then that stock price will go back up in the future. Okay, let's talk about what the test will have. Good news on this test is there are 36 questions, but all of them are multiple choice or true false. And about half of them, and let me just confirm this, half of them are repeat questions from previous weeks. So, because we have already gone over them in prior weeks, I am not going to review the concepts that you need to know that were already on previous week's tests, okay? But just know that you've got material from previous week's tests that you'll see again on this week's test. From weeks 1, week 2, and week 3, about half the test will be from those weeks, okay? Let me just look here and finally get to where we start with some new material. Well, here's good news. I'm still looking through. I'm on number 22 now, and I still am seeing repeat questions from previous tests. Okay. So the first 30 questions on the test are almost all, well, they are all repeat questions from previous tests. So just do a quick glance over on your notes from previous tests, if you've still got them. Review the slides, review the chapters, and you'll be in good shape. And you'll recognize, this class is so fast. It's only been the last 3 weeks. You'll recognize some of these questions from previous tests. Hopefully, when you take a test in a class like this and get some feedback on it, you learn from it, right? Instead of just ignoring it and forgetting it, I hope that you'll learn something and take a few notes when you get something wrong on a test so that you understand the concept, because then you get to the final like this, and if there's repeat questions like this one, where 30 of the 36 questions are repeat, you're going to be in great shape. All right. So the first new concept question from this week is, the question asks us about security analysis, and particularly fundamental analysis. And that's what we talked about from Chapter 7 tonight. So just make sure you understand the concept of what is fundamental analysis and why do we use it. And why are we so interested in getting to the intrinsic value of a stock? Why do we even care about the intrinsic value of a stock? And the answer to that question is maybe too easy. Don't overthink it. The point of getting to an intrinsic value is so that we know whether or not the stock is overvalued or undervalued, and so we can decide whether or not we should invest or not invest. Okay, that's the whole point of fundamental analysis, is getting to an intrinsic value so we can determine whether or not to buy or not buy a particular stock. Okay, make sure you understand that. Number 32 on the test will ask you again about what fundamental analysis is and understanding the basics of fundamental analysis. Number 33 on the test, we looked at some slides in Chapter 7 on how different issues with the economy affect the stock market. Make sure you look at that graphic and just kind of eyeball through and have a basic understanding of the types of issues that impact positively the stock market and the types of issues that impact negatively the stock market, that are economic factors that we see in the economy. Number 34 on the test, we want to understand where the value of a stock comes from. Remember, we talked about the future total return potential of a stock is exactly why we price a stock the way we do. And where does total return come from? It comes from value change, which is from earnings over time, or the growth of earnings over time, and it comes from a return in cash to us in the form of dividends. So earnings and dividends really have a lot to do with where our stock will be priced. But remember, it's not past or current, it's future, right? We're always looking at the future to price our stocks accurately. Number 35 on the test. Number 35 on the test asks you to understand the concept of dividends and whether or not companies are quick to reduce or suspend dividends or not. And we talked about earlier how it's very important for companies to pay out their dividends. If a person invests in a company like Con Edison, which is a company we mentioned earlier that pays a very high dividend because it's a utility stock, if I invest in that company for its dividend, and then Con Edison decides to lower its dividend or suspend its dividend, I'm most likely going to sell. Okay, and so the price of that stock is going to go down dramatically. So management of a company are highly motivated not to reduce dividends. If anything, they're highly motivated to increase dividends, but they rarely will even think about lowering dividends, okay? Because it significantly impacts the price of their shares and the credibility of their company if they lower dividends. Not a good idea, even if it's temporary, to suspend or lower dividends. It reflects very poorly on a company, so management will almost avoid that at all costs if they can. And then when we go to calculate the value of a stock, and this will come from Chapter 8 as well, we have this concept of required rate of return. And this is something that we talked about last week a little bit in the text. But required rate of return is the return that we as investors are demanding from stock, okay? And if we can't achieve at least our required rate of return, we're not going to invest in a stock, right? So if my required rate of return that I expect from the stock is 10%, but when I do my analysis, I'm only going to get 5%. That 10% required rate becomes kind of a hurdle rate, and a hurdle rate is something that we have to get over, right, in order to decide to actually do it. So Sabrina, back to your situation investing in Apple. If you came to the table, thinking, okay, I want to invest in a stock, I want to try this out, I want to own something that's out there. Let's say you could get 0.2% in your bank account, okay, if you put it in your savings account, your money. And let's just say, for you, it's like all I need to do is just get more than 0.2% from the stock because that would be better than a bank account, right? A bank savings account or a bank CD. So that would be your required rate of return, would be at least 0.2% or more based on the fact that you have what's called risk. You have some market risk associated with your Apple stock. And as long as you decided that you had a better chance of getting a better return even with the risk from your Apple stock than you would from a savings account, then you would move forward and make the purchase, okay? A lot of us don't think through it that far, and you probably didn't, Sabrina. I'm just guessing, but maybe you did. But most of us don't think through it that far, but it's something that actually subconsciously we do, okay? If we invest in something, we're investing in it because we think the cost-benefit analysis of it is in our favor, that we're going to end up with more benefits than costs associated with doing whatever it is that we're investing in, instead of just throwing it in a bank account and getting, the little bit of interest that we get right now. Okay, same idea. All right, so that's all I had for tonight. That's all that's on the test, just 6 new questions. The rest of the test is comprehensive information from previous weeks, previous chapters, but most importantly, previous tests, because it's material that you've seen before. And if you've studied for previous tests and you have a few notes from our previous sessions, you'll be in great shape. Now, Sabrina, you're the only participant tonight, so not to put you on the spot, but any questions or concerns about any of the material we covered, anything that you'd like to kind of recap on from a previous week, or any of the assignments that you have questions on, anything that I can do for you before we wrap up tonight? Okay. Well, thanks for joining for the last little bit. Have a great week. Good luck to you. And I hope that you wrap up the class well and then are able to continue on and finish up a degree so that you can have some additional opportunities going forward. So if there's anything I can do for you, let me know in the class or outside of class. I'd be happy to try to help any way I can. So have a great night, and good luck to you, and we'll talk to you later.